Good morning, ladies and gentlemen. Well, unsurprisingly, in a week which saw very little price action close to close, the risk dial also saw very little change in the score. We opened the week at 76, we remained constant and basically improved slightly 1 point, which is really material, over Thursday and Friday. Everything is still pointing upwards in terms of risk, in terms of equities being preferred to bonds on all time scales, including the weekly. We closed at 1 point improvement, and these moving averages keep on going out. I have to apologize for the fact that the site shows as not secure, but hopefully that is going to be fixed today or tomorrow by GoDaddy, who are being extremely slow. And now let's have a look at the individual markets in the individual spreads, where unfortunately not much has happened as well. But before we look at what is not happening, which is just as significant as what is happening, let's have a look at something which has really caught my eye and which I've been expecting for some time, and that is the movement in European bonds. Now, this is the bubble. It broke the range that it was in between 75 and minus 68, and is now attempting to go and fill this gap in this range here between minus 83 and minus 86, basically. I fully expect this range to be touched sometime in the next 1 or 2 weeks, and that is significant. If we have a look at what is happening in the bunds, basically they're following suit. They closed the week below the minus 60 area, and now I'm fully expecting them at some stage, maybe with a bit of back and filling, to go and touch the minus 72, minus 73, and the gap fill to here. You can see how significant this is. We haven't really, this was the panic during the coronavirus initial stages back in February, March, but really we haven't been here since the early part of 2019, and to me that is significant. That is the market basically saying that we are going to get something quite big from the ECB at some stage, that inflation in Europe keeps on going down and being less likely to happen. And as a result, we have a clear break of the previous range between 100 and 125 in the differential between the bunds and the 10-year note. And now I'm really looking upwards, and I fully expect this extreme around 150, 153 to be touched at some stage over the next 2 or 3 weeks. To me, that is significant in terms of what it could potentially be telling us about the election, but let's not speculate about that. But surely it must have an effect on the US dollar and the price of gold. I want to give you slightly more color about the bunds and the bubble. This is a short-term chart of the bubble futures. I first of all always look at the yield chart because that is a long-term chart. You can't really have a futures long-term chart because the basis changes so much and the cheapest to deliver. But what we are basically seeing here is a clear break of 135.37, which was your signal to get in. And now we are probably going to have a little bit of a trading range. So you can see that anything that picks it up below, let's say 135.50 to 40 in this 38.2 to 50% retracement, but keeps above 135.37, which is now absolutely key, at some stage will provide us with a slingshot to go above 136, and those yields that I showed you in the previous clip around the the minus 70 odd 70 to 83 basis points, which is going to be really the extreme and that gap fill that I showed you in the previous clip, and that's about as far as I expected. The best I can guess is that it's going to be between 136.00 and 136.15. This is a chart of the Bund. To me, the bobble is a much better risk reward and a much clearer chart, but for those interested in the Bund, basically we're looking to pick up anywhere around the 175.38 to 175.11 area, and for a slingshot which really should take you around the 177 area. But to me, anything which is above 174.97 is a buy, and that is your clear, a close below 174.97 is a very clear sign that something else is going on and you no longer want to be involved. But to me, I repeat, the Bund is a much better risk reward, both technically, and it makes sense, because if things are happening in Europe and the ECB is going to have to step in and do a lot more help, it's the shorter end which should react more than the longer end. I'm not going to show you the two stands because basically it's going nowhere, and really none of the yields are, the curve is just not moving. It's moving quarter of a basis points at a time. The only one that remains interesting to me is the 530s, because this is just consolidation and it could really break at any time. Anytime you see it going down below 124, you know that the target is 140. It's a long way away. I don't expect it to happen before the election. I expect another 2 weeks of meandering. It's very clear this 105 to 110 area, as long as it keeps on capping, all the danger is to the downside, towards that 140 level, which is so important on the weeklies and the monthlies. It just is, and that keeps on telling me that technology is just not going to improve significantly. It's the one with the longest duration, and as long as the curve continues to have pressure to bull steepen, I just can't see technology having a leading role. Unsurprisingly, in a week which saw the differential in between Europe and the United States go out, the dollar was slightly stronger, and I mean, very marginally, not even 1%. It's still the most frustrating market to trade, and the possibility of 95 to 96 area is still there. This could be an A, B, C, taking us right into the target. If we look on the daily basis, we have 3 wave, maybe another 3 wave, taking us back towards the 0.382 retracement at 96.04, this kind of area, with a big pivot at around 96.50. Now, I've shown you before that really coincides with this very important level in Euro USD, which is around the 115.30 or 115.50 area, depending on if you look on the weeklies or the dailies, but that is neither here nor there. Could we have an ABC here? Yes, but I still think that this area is going to be very interesting to get some options on board for higher prices in Euro USD. What is interesting is that after having closed many times at 118.40, we tried it, didn't quite get there, and last week, boom, straight back down. We couldn't touch it or close above it or trade it. So this 118.40 area we should remember for the future, because when it breaks through and closes above it, it will be quite important. But in the meantime, we're looking down towards this 115.40 area, 40.30, whatever it happens to be. And this is really where the previous support and resistance levels are. And also, 114.90 is the 0.382 retracement of this whole move. So, you have a 50-60 tick range that is going to be very interesting to pick up some options, longer term options, to have a stronger euro and a weaker dollar. Gold has been interesting insofar as it has more or less mirrored the dollar, and that is unsurprising since bonds are doing not very much. The weekly chart, daily chart, what is interesting to me is that we just couldn't bust through this 119.40 area, which had so much trading in this period. This to me says that all those guys are still trapped, and really we are more likely to look lower rather than higher in gold. A lot, probably not a lot. We've actually been trading this spot on. We identified this 118.60 area as the first support. We identified the fact that 119.40, 50, 60 was going to be very tough to break through, and so it proved. I think it's more likely that we give some pain to these guys and come down towards 118.10, which I think is going to be a very good level. Anything between 118.10 and this 117.63, 64 area, which coincides with a very steeply upward sloping 200 MA. I would be very surprised to see it close the week below this level, not given the uncertainty that we have in the United States for the elections and so on. Unlikely to happen. I think if we have a panic and we stop out these guys here, 118.10 is going to catch it. I'm going to be a decent sized buyer, 118.10. I think that is a very good risk reward point to start accumulating. Moving on to risk, I think it's important that you should download these deviation charts on a daily basis. And why? Because I think in the next 2-3 weeks it's unlikely that we go much away from this center line. The markets always tend to mean revert ahead of big events and big uncertainty. So that is where basically I think that we will be going into early November, somewhere around the middle line of the S&Ps. And it also has been very, very good at catching the tops and bottoms. Basically, this is telling me that new highs are very, very unlikely at the moment, and that we are more likely than not at some stage to give a fright to people. This in the longer term means absolutely nothing, and I'm not going against the risk dial. I think the risk dial is right. The spreads are all pointing upwards, but I think we're going to have some short-term volatility before the resolution of the elections, which would only be natural. So what happened in risk last week? Well, not a lot, and let's see the first reason. The first reason to me is that the monthly Bollinger is at 35.16. Okay, I really do not think that we're going to go into the election anywhere near it, simply because it just, it's just unlikely. The markets like to leave some room both on the upside and downside if they are wrong in what they are expecting. On a weekly basis, basically we did nothing. The weekly Bollingers are around the 35, 60, 70 area, and that gap fill, there's no way that I can see that we are in the next couple of weeks going to go and trade above 3600. I just don't see that. I don't see the reason for it. I think we are far more likely to get a couple of whippy weeks before we have the election. So what are the dailies saying? Dailies are basically quite neutral. I think the area that we are all looking at all these moving averages slowly coming up, is going to be, at the moment it's 33.93, but it's going to be basically what the important level, which is 34.28 in this chart, which I think is far clearer than any of the others. We have now a failure to close above 35.01 in the SPX. We've tried several times last week and we didn't make it. We have these moving averages now around the 34.64 area, and below it we have this very important level that we couldn't even touch, let alone break through before, which was 34.28. To me, 34.28 next week is pivotal. If we trade anywhere near 34.28, we are going to have to come down towards, quite a long way into the 33s, and possibly come and test this line again at 33.28, with the possibility of this gap fill. It would not surprise me at all to get this ABC action down, stop everybody out, and then go again. I am looking down for the next couple of weeks, simply because I just refuse to believe that the market can completely ignore the possibility of chaos at some stage around or after the US election. And there is no leadership from any sector that I can see. I think this chart puts it best. You can see the really important levels: 34.28, 33.93, 33.30. I refuse to believe that if we bust 34.28, we only go down to 33.93. So my natural target over the next couple of weeks is 33.30, 33.29.62. That is my natural target for a market which basically has to stop both sides. The shorts have been stopped, now the longs need to be stopped, and the market goes into the election somewhere around 3400. That's my best guess. I think we've established the range before the election, so it's natural to think that we get some A, B, C down, but that's just a guess. But since there is no leadership, that is a decent guess. And now let's have a look at the sector, i.e. the tech sector, on spreads and outrights, and see why there is no leadership. And if that is the case, I think this analysis is more likely to be right than wrong. So this is my technology against everything kind of page, and it's basically showing me that things are very, very stable. We keep on gyrating, slightly up, slightly down, but you have no trend here, and it's natural, I think, that we really shouldn't have a trend for the next couple of weeks. If we look at the one that's been moving most, which is the Qs against IWM, against Russell, we can see that basically for the past 2 weeks we've been in a very wide range, and every time we get to here we bounce, and every time we get to there we just we can't take it. I still think it's more likely than not to come towards the moving average ahead of the election, and that would mean less leadership, even less leadership. It doesn't really matter what I look at, whether it's against the S&Ps. I really don't see that we are in a trend. We would need to start breaking these levels to get leadership out of the NDX. I really can't see that happening ahead of the election. I might be wrong, but I just don't see that we can have huge leadership from any sector before the election. And NQ has actually started performing as one would expect it to perform ahead of a big event, i.e. respecting all technical levels. Here it respected the weekly Bollinger Band on Friday extremely well. Bang, back down. Now we have, the important level here around 11,560 on the downside, and then this ascending moving average. I still think that we are unlikely to go below 11,058, but that is my guess. This chart 195 minute of the Nasdaq is showing things quite well. Let me enlarge this area here so you can see it. Basically 11,846 is very important. We barely closed above it on Friday, during the shakeout. I still think that we need to come down and fill this gap around 11,566. That is my first objective, and that will be, the start of an ABC. At some stage, this kind of area is going to be interesting to buy, and 11,276, and that would coincide with what I showed you in the SPX, the move down towards the gap fill. To me, we are now in a range, and we're going to spit out both sides. As a final justification for my expectation of probably lower prices or probing lower, stopping people out, is that I just can't see that these charts of volatility are anything but bullish. I think the market is more likely to trade up than down. We have tried so many times to bust through 2250 and we just can't do it. And we keep on closing now above this 2681. It wouldn't surprise me to see the 31s. It just wouldn't. And this chart here is actually volatility in the Nasdaq. Again, a touch here around the 40 level. 39.83 to 40 would just not surprise me. And that is why I say that we are more likely to probe lower than probe higher, and that I'm a better seller on rips. It just makes sense to me that we're going to stop people out on the downside over the course of the next couple of weeks. So here is the weekly table. We are still in the range in the 2s, 10s and the 5s, 30s. To me, if we start breaking the 123, 124 area, it shows the intent to go to 140, but I think it's going to be very contained for the next couple of weeks. I can't see any major moves or the reason for any major moves. The Fed is still there, and I think that while the bonds and the bubble are doing what they're doing, it's unlikely that we can get this steepening accelerating in the United States. I've told you about the DXY. I still think that if we see this 96.04 level and 115.50ish or to 114.80, it's a good area to pick up options for the upside in Euro USD and the downside in the dollar. Gold, the pickup area for me for next week is 1810. 1770 I think would be a gift. I don't think we're going to see it. 1810 is where you pick it up. The fact that we couldn't close anywhere near or test anywhere near the 1960, 1970, it kept on failing in the 40s, to me says that we're going to look down in the next couple of weeks, but longer term that is very constructive. If all we do is an ABC after such a big move, it really opens up the upside for the longer term. XPX 34.28 is huge. I think we will see it, and I think we will break it. We didn't break it first time round. We'll break it second time round, third time round. I have no idea, but I think we'll definitely break it. And if that happens, I can't see that anything below the 3030s and the 3300s holding it longer term. I think if we see these levels, those are buys. Those are buys for the longer term, because I don't think the election is really going to be that much of an event. I think it's important. I think the market is going to respect the volatility ahead of it, and I think that those are the levels that you want to be long at. Now, on the upside, if it starts closing in those 195-minute periods above 35.01, which has said repeatedly failed to do, that is a sign of strength, and that I am quite possibly wrong. The weekly resistance and the Bollingers are not until the 35.60s to 35.80. This area here is a very good area to pick up puts. End of story. NQ, first support 11.566, major 11.276, and a pivot below there. Very bad things happen. Can't really see it happening. If we see 12,300, I am a buyer of puts. End of story in NQ. Now, EEM has done nothing on the week, but it's still closed above 45, and the major area of resistance is 47.90. Don't forget, EEM is really not that correlated to SPX or NQ. So I'm really not worried that one has to go down with the SPX. I don't think that necessarily follows. If we ever see the 41, 40 to 42 area, that is such a gift. I'm going to be such a big buyer there. The interest rate markets, as they were last week, and I think they will remain this week because we could easily get a continuation, is the Bund and the Bobble, and here you have the levels quite clearly marked, and also where these markets are likely to go. The Bund, if we get to minus 72, minus 73 basis points, you're looking there to get out of all longs in the futures, and you're looking to reverse via options, looking for a move to minus 60 as a minimum. Bobble, it's likely to be the ultimate target. It's likely to be 136. Give it 10 ticks to the upside. Should coincide in minus 83, minus 86 basis points. This one to me is much clearer, and also the one where I don't want to fight it on the way back. I much prefer the Bund for the way back and the Bobble for the way there. Thank you very much indeed, and tweet you on Monday.